What's up, guys? It's Cash Flow Cart, and today we are talking about JEPI, JP Morgan's Premium Income ETF. Just to preface this, I guess 2 weeks ago I posted a video about JEPI, and it got a lot of feedback, a lot of interaction, more so than any of my other videos. There was positive comments, negative comments, but I think some of the negative feedback from that video was probably sparked from like how spontaneous it viewed. Okay, so today it's going to be a new me. We're going to go through, the prospectus from JP Morgan. We're just going to talk through it. We're going to be very calm. It's going to be awesome. So stay tuned. I mean, let's look at a few of these comments. We might come back to them. This guy said, "You're not ready for prime time, bro." I don't know really what he meant by that, but I guess I'm not ready to make a Star Wars movie. This is a dividend vlog. Okay, moving on. Let's just jump into this. We're going to go through the prospectus. So like I said, if you invest in JEPI, hopefully you've done some sort of due diligence on, I guess, the methodology of the fund, how it works, the goal of the fund, maybe what it's for. Regardless, we're going to read through some of it today. It looks pretty boring, but I'll try to point out the stuff that matters and explain it in plain English. Excuse me. So, what is the goal of the fund? It seeks current income while maintaining prospects of capital appreciation. This is very important to understand. While maintaining prospects of capital appreciation. Okay, guys, this doesn't mean it will, generate the same capital appreciation as, the underlying market, but we'll get a little more into it. Okay, the annual operating fee is 35 basis points, which is pretty low relatively. We'll give it a thumbs up there. It's a low annual fund operating expense. So, moving on to the meat and potatoes of this, I guess, we're going to look at the fund's main investment strategies. Okay. So, like I said, it wants to seek current income, mentions it again here. And here's how JEPI, or I guess the managers of the fund at JP Morgan, here's how they want to do this. They created an actively managed fund of equity securities comprised of those in, the S&P 500 index. Okay, there's two parts of this portfolio. One, which is going to make up about 80% of the holdings. Okay, 80% of the holdings in JEPI are going to be in securities or stocks that are in the S&P 500. And that 80% is really this part here. It maintains prospects for capital appreciation. So because they have those stocks on their balance sheet, they're able to say there's prospects for capital appreciation. Okay, fair enough. And then two, equity linked notes. Okay, so this is going to be mainly the income part. They're going to sell call options, with exposure to the S&P 500. Let's dig a little deeper into this. Okay, so here we are. Sorry. These equity linked notes, or ELNs, which are, they're call options that are specially structured, are going to make up 20% of the portfolio. Okay, guys, let's just keep this in mind. We've been talking about it. 80% stocks, 20% of these ELNs. And then a selling point here for JEPI is it seeks a lower volatility level than the S&P 500 index. And I've seen that thrown around like, okay, JEPI's got a lower beta. It's good for lowering, portfolio volatility. I don't really think that's fair to say out of context here, because all it is 80% of these stocks in the S&P 500, and then 20% of a very, illiquid, specially designed ELN. So, if we can talk about this, if I can put this in a little plainer terms, if I have a portfolio that's 80% S&P 500, 20% in just cash or sidelined cash, is it fair for me to say that I have a lower volatility level than the S&P 500 index? Oh my gosh, my dog is, I don't know what she's doing. Is it fair for me to say I have a lower volatility level than the S&P 500 index if I have 80% S&P, 20% cash? While I may have a lower volatility level, that metric is taken, so out of context. So, if that's one of your main arguments for buying JEPI is the lower volatility, then that's not really, I don't think that's really valid. Okay. Moving on through this. Okay. So let's scroll down into their main investment risk. Okay. Subject to management risk. Obviously, it's an actively managed fund. May not achieve its objective. Advisors' expectations regarding particular instruments or markets are not met. And there was actually a comment I saw on Reddit that kind of summed this up well. And the guy was talking about, okay, while at JEPI, they have had this, impressive trailing yield. Now they've got that pressure put on them to continue, similar levels of monthly payouts. Does that make sense? So are they necessarily going to manage risk as best they can, or are they going to prioritize keeping those monthly payouts the same? Does that make sense? And, I think to further drive this point home, I'm going to go to a whiteboard real fast. So here we go. Okay, guys, bear with me. I know this is not the most ideal setup, but, if I can be a professor here for a quick minute with my whiteboard. Let's talk about how covered call ETFs work, just broadly. And let's connect that back to, what the fund managers at JP Morgan have to do in order to generate, those premiums rolling in so they can pass them out to shareholders. All right. So I got my whiteboard. We'll see how this comes out. Okay. So here's what we're going to do. We're going to simplify things a little bit. Here, you guys see that? This diagonal line, we're going to say this represents the S&P 500. I understand that the market doesn't move up in a straight line, but for all intents and purposes today, let's just keep things simple. Okay? So every month, the managers at JP Morgan are selling, covered calls on the S&P 500. Okay? So, January, we're here. JP Morgan managers are selling a covered call here. Okay? When they sell that covered call, it's going to bring in premium, that's where the name of this comes from. The premium income ETF. It's not premium like you'd think, like, oh, premium. So they're bringing in this money here. Okay, next month, same thing. They're selling covered calls above the market price of the S&P 500. All right, this looks like it's pretty simple to do when you have a straight line, but obviously we all know the market doesn't just move up in a straight line. Are we following? Okay, so what happens when the market falls? Okay, now on the way back up, as JP Morgan is selling these covered calls month after month to bring in that premium, okay, some of these strike prices, some of these, ceilings, if you will, they're getting hit. Does that make sense? And essentially what that does is limit any further upside until expiration, until they can, do another covered call strategy. Are we following? So while JEPI may have, prospects of, following the market or whatever it said there in the verbiage on the prospectus, it has prospects of capital appreciation. When this ETF falls and JP Morgan, the managers there, still have that same kind of pressure to reward shareholders with those, 40 cent, 38 cent, whatever monthly payments they've been doing. I haven't really been following it that closely. When they still have that same kind of pressure, they're going to get maybe a little more aggressive with these covered calls they're selling. They want to bring in that premium, but they have less underlying value now. Are we following? So as they get a little more aggressive with those covered calls, essentially what's going to happen is it's going to really limit, JEPI's ability to recover fully to the upside. Okay? And with all this being said, that's going to lead to one thing, in the long term. I'm going to write this word out. That's backwards right now. I'll try to do some cool editing. Decay. The word is decay. Okay? So as JEPI falls, even though those underlying S&P securities are recovering, as the managers sell those covered calls, they bring in those premium payments. Essentially, they're putting every month ceilings on or not ceilings, but caps, a strike price that the the S&P 500 cannot appreciate past. This is my first time ever trying to teach something on a whiteboard, so bear with me. But, I hope with this sort of structure of using the prospectus, using some visual tools, I look really weird with this, uplighting. Sorry about that. Using some visual tools, this is kind of going to start to get you guys thinking, okay, maybe if I am in the earlier stage of my journey, does it make sense now to invest in something that, is not going to build wealth in the long term? All it's essentially going to do is generate income. And if you want my honest opinion, I don't know down the line if, those increases, those distribution or dividend increases are going to keep up with inflation. If they're even going to be able to increase at all year over year. Because as we see this decay and we see the JEPI ETF, getting less inflows, it's been so popular these past 36 months. It's going to be much harder, for the managers over there at JP Morgan to kind of, generate these returns and keep this image of, tracking the market. Okay. Having prospects and having holdings in the market does not necessarily guarantee any sort of capital appreciation. So let's get back to some sort of normal setup here, guys. Sorry about that. If that kind of crazy whiteboard explanation didn't really resonate with you, let's go back to the prospectus. Let's see how JP Morgan says it. Because they're going to say it in a much more sophisticated way. And if you're new in this game, sometimes when, big companies like JP Morgan, when they hit you with these fancy words, it's going to be tough to kind of, see through. Especially if you're unfamiliar with like any options trading strategies to begin with. But, this JEPI ETF is being pushed by big YouTubers, pushed on beginners, beginner dividend friendly ETF, JEPI, 30%. All right. Let's reel it back in. This is how JP Morgan says it. Covered call strategy risk. Okay, they, like I said, very sophisticated here. When the fund sells call options within an ELN, again, which this whole ELN thing is like they're getting, notes made specifically for them. Like I said, there's not really volatility when you have an equity linked note designed specifically and catered to your own needs. There's no liquidity or volatility, within something that's made for you. Okay. Are we following? So when they sell call options, receives cash. All right, that's that premium income. It's coming into JP Morgan. They can return it back to you, but limits its opportunity to profit from an increase in the market value of the underlying instrument to the exercise price, plus the premium received. Okay, so with all those lines, and I was calling them strike prices, they say exercise price. Same thing, really here. They're putting it right here, but I understand that a lot of you guys aren't really. I mean, I'm not trying to call anybody out, but a lot of, investors in JEPI, they're not really taking the time to fully understand what are the risks here. Okay, what is this for? And, I've seen some. I mean, this guy was complimenting me, so that was very nice. I've seen some other arguments for, this JEPI ETF being used as sort of an annuity where you're not really worried about any underlying principle. Okay. All you're worried about is, collecting income, maybe using that income to pay bills, whatever. But, I guess I get that. But, also from my point of view, being a 22-year-old who's focused not only on passive income, but also extremely focused on wealth building, nest egg, and dividend increases, I can't really get behind this way of thinking of just, he says never selling the principal, but I think he means here is, but you're okay with the principal, evaporating. Okay, so I can understand that line of thinking. And then one other quick note before we wrap this up, guys, is going to be, if you are in a situation where you do want to use JEPI, I would say the best advice I can give you for it is going to have to be in a tax exempt account. Okay, because if you're racking up this premium income and that principal is decaying, if you're trading this just in an individual account, that tax bill on those payments is going to make this, not even profitable year to year, if you want my honest opinion. Okay, so we've kind of been all over the place, but thank you guys for joining me. Like I said, I'm Cashflow Cart. I drop new dividend content on Mondays and Thursdays. I'm fairly new to this YouTube thing, but if you want to subscribe and help me out, I don't know why I'm getting all sentimental. If you want to subscribe. I'm going to be sharing my journey, my portfolio, I guess some of my buys, some lessons, and then some random stuff like me talking about JEPI for 20 minutes or whatever this is. Anyway, everyone have a great day, and I'll catch you in the next one.